Well, good morning, everyone. Thomas Montgomery here. We get together most weekday mornings at 8 o'clock Central to visit with you to talk strategies, tips, techniques, share success stories, and support each of you. We are on Tuesday, July 22nd, 2025 is the date of today's recording. Had a really good discussion yesterday on the outsourced marketing program. Many of you have opted to participate. We have a few slots left. If you missed that training, you may want to go back and visit it. But today, we're going to talk about the most foundational, most important concept of what you and I do. What we do is we create fundable businesses. Now, I understand that the typical client wants business funding, but what do we know? We must have a fundable business or we're not going to be able to qualify for funding under the EIN. So, with that, we're going to go back and just review some of the basics and then also talk about what makes what you and I do, unique in the sense of how we've packaged everything to be able to deliver to any client and guarantee a large business capital raise. So, with that, our website, of course, is 509 Pacific. The support text line is 903-347-8042. So we're going to break this down into two sections, the foundational elements, and then our main conversation is going to be on the three C's. So even if you're very familiar with the three C's, I still think that you might benefit from today's discussion. So but you can let me know. And again, if you have any questions, comments, concerns, type it into the Q&A. So again, if a client has a problem, which is they need money to start or grow a business, you and I have the solution. But it's not that we're a bank, right? So they don't come to you, Carlos or Charles or Claude or Corey or Doug or our program specifically to get funding. We need to first help them have a fundable business. Now, it's true that different types of funding have different underwriting criteria, but our focus in general, and also in our discussion today, is helping clients qualify for large, low interest business loans. Normally, they're paid back over 10 years, over 120 months, and that allows for the lowest possible payments. So the first thing that we know that we need if we want business funding is we need to have a business that is in good standing, and that means both at the state and federal levels. So if it's a new business and it's filed properly, then it's in good standing. If it's a business that's been around, then there are typically filings that are needed on an annual basis. But we certainly need to have a business that's in good standing, and we provide that through the shelf corps. The industry code matters. The risk associated with each business is impacted by the industry code. All of our shelf corps are set up as a management consulting firm, which makes it low risk and easy to get funded. And then we also need to have a unique commercial address that's associated with the business and on record everywhere, including the state and federal filings. This is something that we include. So we include with the Shelf Corp the entity and the client's name. It's clean. We provide it is of a management consulting industry code. We provide the address. Now, the client will pay for mail forwarding, which makes sense. No matter where the client would have an address, they would anticipate needing to get the mail forwarded to them. So that is an a la carte expense. However, we are providing the address for the lifetime of the business. So it starts with these elements, and that's pretty basic. I understand there's not a lot that's unique. Now, with the grant, we're providing these items and also a business plan. The business plan is really important for traditional business loans to explain to the lender what the business does, what it needs money for, uses of funds, and so forth. And then also financial projections are included. When a client gets a fundable shelf corp from you or from us, we can make changes. If they don't like the name of the entity, we can change it. If they want us to make changes to the business plan or the financial projections, so everything's editable, but it really comes like a business in a box. It's ready to go. So those are the foundational elements. Good for you to know. You probably already knew that. But the more interesting part of our discussion today is how our shelf corps, through the grant, can provide the three C's. So the three C's is a basic concept in business finance that summarizes what it takes to have a fundable business. So what I want to spend a little bit of time with you today is to talk about what each of the three C's stands for, how it's measured so we can determine if we have it or not, and then the role that you and I play in assisting with that. So, in no particular order, let's start going through the three C's. So, we're going to start with the first C of credit. Now, the truth is that there are two types of credit, there's personal and then there's business. Obviously, if what we're trying to pursue is business funding, our primary focus is going to be on the business credit worthiness. But however, regardless if it's personal or business credit, what is credit a reflection of? It's a reflection of our payment history, whether it be a person or a business. How much credit has it had access to? Has it paid as agreed? Is it reliable or is it risky? The entity or the person. Makes sense, and I think we all know that. Typically, the way that we have high credit, whether it be personal and or business, would be by having the presence of positive credit and the absence of derogatory credit. Misspelled that, didn't I? Derogatory. Let's do the spell check. Oh. So with that being said, I misspelled credit too, didn't I? So with that, what that means is we need on the credit report, which there's different types of credit reports for people and businesses, different bureaus. But in either case, we want to demonstrate on those credit reports because lenders and extenders of credit are often going to, and of financing, of funding, are going to typically check the credit reports. So regardless if it's personal or business, the concept is the same. We want to demonstrate positive credit and we want to have an absence, or in other words, no negative items. Makes sense. But let's drill into, so how is it measured? It's measured on credit reports, different credit reports. But from the business perspective, which is our primary focus, we're going to focus on getting a good PAYDEX score. So PAYDEX is issued by Dun and Bradstreet, which is one of the major business credit bureaus. PAYDEX scores go from 0 to 100. We want to have at least an 80. Now, you don't have to have a 90 or 95, so as long as we have an 80, we're fine. Now, how is it that we go about having an 80 PAYDEX score so the business looks creditworthiness? Well, what we do is we add trade lines. So trade lines would be how we're getting the positive credit on the business credit profile. So that's part of what we do for each shelf corp is that we add trade lines. Now there are no negative items, so it's not like we need to go do a cleanup, but with the absence of derogatory, we need to still focus on having positive credit. Specifically, what we're going to do is we're going to add 4 trade lines. What are those trade lines? Well, they could be anything from business credit cards. I believe every business should have at least one business credit card, right? When you're taking a client out to lunch, when you're traveling, paying your airline ticket, putting fuel in your company car. There's routine expenses that you don't want to be paying for personally. So business credit cards make sense. We can get a business automobile, one or more. That would be an example of a real nice trade line. We could get business real estate, and then there's others like net 30s or what have you. But the bottom line is we need to have the three C's to have a fundable business. The first of the three C's that we're talking about is credit. Our focus is on business credit. Now, again, if someone has weak personal credit, we assist them with that because we have the free credit sweep. And then also we can add trade lines here as well. But our primary focus is on the business side. We're worried about the PAYDEX score. It goes from 0 to 100. We want to have at least an 80 PAYDEX score. That's good enough. The way that we get that is, well, we first, by the way, will get a DUNS number. So that's a unique identifier associated with Dun & Bradstreet, and that's free. And then from that, having that DUNS number, we're going to add trade lines. Technically, you don't need 4 trade lines. Technically, you need 4 payment experiences, but the quickest way to do that is to add trade lines. We work with each client to figure out what they want. Do they want 1 or more credit cards? That's real, so it's usable. Do they want 1 or more automobiles, real estate, others? So that's the first of the 3 C's, probably what you're most familiar with, but I wanted to start with it. Anyone have questions on the functionality of the first C, credit? Okay, great. So I think we're rolling. Well, I see that Ben's asking, so are there PGs, personal guarantees, on the trade lines? Well, some do and some don't, so we'll work with the client. If the client only wants trade lines with no PGs, then we can set it up that way. If they don't care about having a PG, it wouldn't report on their personal credit. It just means behind the scenes that they've guaranteed it. But yes, we can do these with no PG if that's what the client wants. All right, so that's the first of the 3 C's. It's the most obvious, probably of least interest to you to discuss, but we wanted to cover it. Now, let's go ahead and go to the next C, which is collateral. A lot of people get confused on collateral. So, what is collateral? Collateral are the assets owned by the borrower, which in this case is the Shelf Corp, that can be pledged to the lender in case of default. So, client goes, gets a business loan. What happens if the client doesn't pay the business loan back? Well, the lender doesn't want to be left exposed. So typically for these types of loans, the lender is going to want to see that the borrower, which would be your and my client, the owner of the Shelf Corp, it's going through the funding process, has enough assets that if the loan isn't repaid, that the lender can mitigate their risk. So that's what it is. In terms of how it's measured, let's go ahead and go back to our bullet type format. So how do we measure collateral? Normally, we look at the balance sheet. The balance sheet of the business is going to tell us what the assets are of the business, the liabilities of the business, and the difference between the two is the book value of the business. So we help clients create a balance sheet. Now, I do want to differentiate. The balance sheet is different than these financial projections. So the financial projections comes to the client automatically, normally about 7 days after they enroll in the free Shelf Corp. So this shows what we think is going to happen in the future, but that is different than a snapshot in time. So a balance sheet is a snapshot in time. We believe the best way to generate a balance sheet is to use QuickBooks. QuickBooks is the nation's leading small business accounting software. It's affordable, it's easy to use. Accountants can link into it. You can link your QuickBooks to your business bank account, so it's automatically recording transactions. But ultimately, QuickBooks will allow us to generate a balance sheet just by a couple clicks of the button. So as long as we have the data of the business in QuickBooks, generating a balance sheet takes 30 seconds, if that. It's click on it and save it as a PDF. So that is part of what we do with each client. Now, you might say, well, what's going to be on this balance sheet? If they're just getting a shelf core, what's going to be on it? Well, on the balance sheet, it's going to, of course, have assets and liabilities, and typically they're not going to have any liabilities, no debt, but we still have to put a balance sheet together because the lender won't assume that. But from an asset perspective, let's look at some of the assets. So certainly there's the cash in the business bank account would be an example of an asset. If we went and bought a company car, that would be on it. If we went and bought company real estate, that would be on it. But you might say, well, this is probably an early stage business. They're probably not going to have a whole lot of cash. Therefore, what we've learned to do, it's legal and ethical, is to leverage accounts receivables, otherwise known as AR. So we provide some free AR with each shelf corp. And then if the client needs more, we can transfer more. But AR is amazing. So let's drill into it just a little bit more so you understand. So, AR means money owed to the business. It doesn't have to have been originally owed to the business. It can be transferred, and that's what we're doing. We're transferring AR. And so it's real. It's real, it's collectible, and can be pledged as collateral because it's an asset of the business. But what some of you don't realize is that we can actually liquidate it. And we're actually doing a massive re-engineering of how we help clients liquidate. So starting August 1st, we'll have our new liquidation model, which is incredibly impressive. But the bottom line is we need assets on the balance sheet to show the lender that we have collateral. The assets for most of these businesses will primarily come from two sources, one of which will be whatever cash they have, the second of which will be the AR, which we transfer. We provide some free. If they need more, we can get them more. The AR works as collateral, but more than that, we can literally go collect that AR for the client and turn that into cash. All right, so let me see if there are any questions on collateral before we move forward. Let's see. I think we're okay. There's a number of comments here. I'm just trying to go through. So I think we're okay. I see a question from Jerome back on credit. So going back here, normally it's just a 30-day process to add trade lines, right? Because trade lines are real. They're reported by what's called data furnishers. So if you and I went, I'll pull my card out here out of I have a wallet on my phone. So here I have, I didn't grab the right one. I have a Chase Business Unlimited Ink card. It's you hear that, there it is. So I have a $50,000 Chase Ink card as an example. So we can get clients one or multiple cards. So Chase is the issuer of the credit card. It's a real 50,000 that I can use, and I do use. And Chase is a data furnisher. They report to Dun & Bradstreet once a month. Most data furnishers report monthly. So going back to Jerome's question, yeah, we normally need 30 days to get these trade lines reporting. Okay, so with that being said, let's get back to collateral and see if there's any questions on collateral. So collateral is important. Most clients don't have enough, which is called a collateral shortfall. These are the assets that's owned by the business that can be pledged in case of default. We measure it on the balance sheet, and if the client has a shortfall, not a problem, never a problem. We can fill up the balance sheet legally and ethically with assets in the form of accounts receivables. Those serve two benefits. They're able to be pledged as collateral, and then also we can liquidate. Okay, if there's any other questions on that, let me know. So what are we discussing? We're discussing how to create a fundable business. Most people don't know what you and I know. We need to start with the basic foundational elements. They get that right away within 7 days with a free shelf corp. All they do is they pay the processing fee. They get that because of the grant. And then we work with them on the 3 C's. The 3 C's include credit. If they have personal credit issues, not a problem. We'll help them with that. But our real focus is on business credit. We're going to add trade lines so we have a strong business credit profile. Second of the 3 C's is collateral, which we just discussed. So that takes us to the third C. Who knows what the third C is? Can you type it in? Everyone that knows, type it into the Q&A of Zoom. What is the third C? Anyone know what the third C is? Yep, a number of you have it. Technically, it's called capacity, but sometimes it can be referred to as cash flow. So what we said, we're going to look at each as far as what it is. Well, capacity or cash flow is the illustration that the borrower can afford to repay the loan. Right? Makes sense, because if the lender wants to be repaid, they're going to want to try to discern, can the borrower afford the loan? Now, it gets a little more complicated, and I saved this one for last because it is the most complicated. So we're able to demonstrate that through a couple different measures. So how do we demonstrate adequate capacity? Well, one of which is through the projections, and that's already done for the client. So again, if they want to change it, they can change it, but by default, we're selling them or giving them through the grant a shelf corp, management consulting firm, business plans done, financial projections are done. So we're showing to the lender, yes, if we were to borrow money to grow, we would be able to repay it. So our projections is an important part. However, what can really, excuse me, strengthen the file would be actual cash flow. So this is one of kind of the tricks of the trade to allow clients to qualify for a larger amount of funding. Now, I realize that you might say, well, that doesn't make sense, right? We can show them projections, but are these businesses going to really have cash flow? Yes, they should. And it ties directly into what we talked about yesterday with the outsourced business development program. It's designed to put $100,000 monthly into the client's bank account. Doesn't require them to do anything other than just participate in the OBD, which we discussed. They don't have to learn to do something. They don't have to go sell anything to anyone. But the actual cash flow is crucial to qualify for the optimal amount of funding. Does that mean that if we don't have this, let's strike through it for a second. Where's my strike through? Here. So does that mean if we don't have cash flow that we can't get funding? No, no. For instance, the SBA 7A loans that go up to $5 million, and they technically do not, by underwriting standards, the standard operating procedures of the SBA does not require actual cash flow. We can borrow off of projections. However, what would create a stronger file is to show proof of life, proof of concept. Let's look at a couple examples. We've got Mr. Stockton on here. Let's say that Mr. Stockton's going to open a restaurant. Well, he's not going to have any cash flow until the deal's funded because he's got to get the location, the inventory, the staff, be open for business. So a restaurant is an example, or a new hotel is an example where there wouldn't probably be, unless we're acquiring an existing one, there wouldn't be cash flow. It's all projections. However, what we're doing is keeping it as simple as possible using management consulting. Well, management consulting is not like a restaurant, right? We should be able to start demonstrating income right away to increase our fundability. And we have a tool to do that, as we discussed yesterday. So this is really, really helpful in helping clients qualify for larger capital raises. We have both the projections and the actual cash flow. All right, so let me recap and then we'll get to any questions that you have that I've not addressed. Our goal today is to explain why this isn't too good to be true. It's not a scam, it's not a farce. What you and I do is we help small businesses qualify for business funding and then get funding. So phase one is providing them the foundational elements. We call this phase one. Because of the grant, we give this away. They just pay a processing fee. You determine what that processing fee is. You're paid off of that. And then we can go into phase two, which is the funding phase. And so that means we're going to prep them up. So typically over a 30-day window. Now, that doesn't mean that we have to wait 30 days to start getting funding. Not saying that. We can actually, from the time that we go into phase two, we immediately apply for working capital. So phase two is going to generate some initial working capital, but to qualify for the larger business funding, we have to be cognizant of the 3 C's. Credit, with our focus on business credit. If they have imperfect personal credit, not a problem. We'll help them with that through removing negative and adding positive. Collateral, we provide collateral that's reflected on the balance sheet as assets. They bring their own in terms of whatever cash they put in the bank account. We give them some AR, and if they need more, we can give them more, and then we can turn around and liquidate that. We'll have a big discussion coming up soon to help you have a deeper dive into this as we're revising it, and it's typically measured on a balance sheet that comes from QuickBooks. And then capacity. And this is one that really is a magnificent arrow in the quiver that you and I have that others don't. That we can literally take the client, get them into a shelf corp, and start actual cash flow. So that way there's real money going into their bank account. It's not a debt, it's not loans, it's real money that they can use. All right, so I see Armand has a question, and I want to break that. And it's a great question. So the design of the OBD, which provides the cash flow for the clients, is to put $100,000 a month into their account. Can it be more? Sure. Could it be less? It could be, but it's designed to put $100,000 a month into their bank account. With that, and his question is, can they spend it? So what we would ask is, of the 100,000, they're free to spend 80,000 of it, but we ask them, they don't have to, but what we request is we request them to retain 20,000 because we want a 20,000 ending bank balance in their business bank account. So each month that they want to participate in the OBD, 100,000 of real deposits going into the client's bank account. It's all their money, it's not debt. They're free to spend 80% of that, but we would ask if they would set aside 20% and maintain a good, healthy bank balance. All right, so let's get into your questions now that I've covered it more than once. And again, if you have individual questions, you can always text us. But let's see what we have here. Let's see. Drake's asking about the trade lines, and so maybe I addressed it after Drake typed it. So yes, we work with clients to add the trade lines. We'll work with them on whatever mix they want. So it could be, it doesn't have to be these. It could be any combination. It's up to them, but we have the ability to add these easily. Jacques asks, is citizenship a factor? No, and we've talked about that in other trainings. Doesn't the participants in the grant to get a shelf corp, they don't have to be US based. Jerome asks, as far as timeline, so yes, we're going to deliver this normally in around 7 days. So that's the norm. And then if they want to go into phase 2, then that's where we work on the 3 C's. And then, of course, the end goal is to go to the funding. That's the goal. It's put 3 asterisks on each side. So the funding is the end goal. However, we need to have a fundable business. So normally we would spend 30 days working on these elements, the 3 C's, so then we could go to funding thereafter. Now, in some cases, we have clients that want to go to funding right away. They want to disregard the 3 C's. And if that's what they wish, we can do so. But obviously, it's not going to be as strong of a file. No surprise there. Jerome's also asking about bank statements. That's right. Yeah. So bank statements, we're creating strong bank statements. And I guess I should have added that. So, how do we measure capacity? It's a combination of our income statement, which means the same as profit and loss. And we can print those out of QuickBooks very easily, like the balance sheet, and then also bank statements. So can we get a business funded that doesn't have actual cash flow? Yes. The SBA 7A, for example, does not require that the business be cash flowing. Is it better that it is? Of course. Are we going to be able to borrow more money? Of course. But sometimes we have to look at what the client's wanting to do. The examples of buying or building a hotel or opening a restaurant, there's not going to be any cash flow in advance. So in some cases, that's not possible. Maybe the client is wanting to acquire an existing business. Well, then that existing business probably does have cash flow. All right, let's see what other questions there are, if there are any. Jerome's asking about the first tranche. No, so the first tranche, and that was my fault. The first tranche will happen right away. So this is what we call the first tranche. So the first tranche will happen, frankly, when we deliver the foundational elements, the shelf court packet in around 7 days, we immediately then go for the first round of funding. So we're applying for it around 1 weekend. It's typically funded within a week after. So they're getting their first tranche, let's say, in around 14 days from the time of enrollment. So I'm sorry if I left you misunderstanding that, Jerome. But that's the first tranche. That's based on their kind of their baseline credibility. To build up the 3 C's, we normally need a month before we go for the larger, we'll call it the large business funding. Good question, Jerome. JC's asking about the OBD, and so it's flexible. It's designed to put 100,000 a month into the client's bank account and on their bank statements. financial statements, but certainly we can drive a larger amount if needed. But 100,000 is a really good number, so that's kind of the minimum we'd like to see. So does a client have to have 100,000 in income in a month to qualify for business funding? Of course not. But what we want to do is have a really strong file. Jennifer asked about the trade line. So again, yes, we work with each client to determine what they want and help them with the right trade lines based upon their needs, wants, preferences. Toby in all caps asked, could someone buy an Express Shelf Corp, apply for funding, and use the working capital? Yeah. So that's exactly right. The design, Toby, is exactly as you stated, just explained to everyone else. Other than the cost to get the Shelf Corp, which the cost is waived through the grant, but they're paying the processing fee, which you determine. Other than that, the design is for the program to be self-sustaining. So when they get this initial tranche of working capital, that provides them working capital from that point until we're ready to go for the large business funding. Plus, of course, we're able to add cash flow from the OBD, and we're also able to add cash flow from liquidating the AR. So you can see these two are kind of interrelated, because once we start liquidating, this becomes a capacity contributor. Let's see here if there's any other questions. Dante, we'll do this as the last question. How long does it take to get the documents? Well, that's what I mentioned, normally about a week. All right, so with that, thanks everyone. Again, yesterday we covered the OBD in a lot of detail. If you want to go back, you can view it on our YouTube channel. But as far as today's goal was to help you understand what we do. What is it that you and I do? We help create fundable businesses so clients can get funding. I know. What they want's funding, but it's too good to be true to just say I want funding. We need to qualify first. The way that we help them qualify is providing them the foundational elements initially, working with them, then building out the 3 C's. Anything that we need to do to change, we can help them. If they didn't like the original business plan that kind of came ready to use, we can edit it. If they don't like the financial projections, if they don't like the name of the Shelf Corp, all those are editable. But this does come ready as kind of a business in a box ready for 100,000 capital raise. If they want more than 100,000, then we're going to need to start making some edits, which is fine. So if you have any individual questions, recommend use the support line. Thanks, everyone. We'll see you back tomorrow. Have a good day. Bye-bye.